Hi, everyone, and apologies for the gap in between these weeks in review. The last couple of weeks have been a bit frantically busy, so we're catching up today. So this week we are reviewing the week from June 7th through to June 13th. Is market pessimism actually driving a quiet surge in buyer activity? Kia ora, everyone. I'm Debbie Roberts, owner and financial advisor at Property Apprentice. This week, we're unpacking a highly unexpected shift in Kiwi consumer psychology. While optimism about rising property prices has completely halved over the last 2 months, buyer intent has actually jumped, led by a determined wave, especially of first home buyers, capitalising on widespread listing choices. Widespread provincial growth is quietly outperforming our major city centres, and New Zealand's rental market is beginning to rebalance in ways that put Australia's severe rental crisis to shame. We'll also look at Auckland's looming July rezoning decision that could structurally impact house prices for the next decade, and a cautionary tale from the Disputes Tribunal that highlights why mixing friendship with real estate requires ironclad legal boundaries. There's an incredible amount of strategic insight to cover today, so let's get it stuck into it. Topic number 1 from New Zealand Advisor on the 10th of June. New Zealand buyers are moving despite the gloom. New Zealand's national average asking price declined 2.5% in May to $833,800, leaving the market virtually flat on an annual basis, with a minor 0.2% decrease. A stark regional division has emerged across the country. Auckland's average asking price fell 2.1%, and Wellington dropped 6% year on year, whereas Southland surged by 10.2%, Bay of Plenty rose 4.1%, and Canterbury gained 3.3%. Consumer optimism regarding property values contracted sharply over a 2-month period, as the proportion of people expecting price increases fell from 46% in March down to 29% in May. The share of survey respondents forecasting price drops nearly tripled over the same time frame, climbing from 6.5% to 16%. Supply pressures remain elevated, with the number of active sellers increasing 3%, building upon a decade-high peak of 37,500 national listings recorded in March. Overall, active buyer intent grew 6% from March, heavily driven by first-home buyers, who accounted for 27.5% of all property purchases in the first quarter of this year, marking their highest annual tally since mid-2021, remember that boom, at approximately 24,800 properties. Property investor participation contracted by 3%, signalling that the near-term pipeline is predominantly occupied by first-home buyers and owner-occupiers ahead of the Reserve Bank's upcoming official cash rate decision on July 8th. So if we look at the shift in consumer psychology right now, the latest Trade Me Winter Pulse survey shows that optimism about rising prices has effectively dropped or halved in the last 2 months. But here's the fascinating twist. This drop in price expectations isn't causing buyer paralysis. In fact, finally, I think the message is getting through. Active buyer intent is actually up by 6%, and it's being led almost entirely by first-home buyers who snapped up nearly 25,000 properties over the last year, which is great news. What we're witnessing is a highly rational market correction. Buyers are seeing a decade-high volume of listings and recognising that the ball is actually firmly in their court. For investors, notice that regional divergence. While Auckland and Wellington are cooling off, Southland's up by over 10% and the Bay of Plenty is up by over 4%. The lesson is clear. Stop looking at the flat national average. The opportunities today are sitting in some of the regional markets where entry costs are lower and local demand remains exceptionally resilient. Just make sure you get a right plan though. Don't just go out and buy something because I said Southland was doing well. Topic number 2 from RNZ on the 10th of June. Suburbs where house prices are falling and rising the fastest. A comprehensive analysis of suburb-level housing data reveals that 56% of New Zealand suburbs recorded stable or increasing standalone house values over the 3 months leading to June. The strongest price acceleration occurred in provincial and rural areas, with Southland and the West Coast containing 21 of the top 25 fastest growing suburbs, led by annualised gains exceeding 14% in locations like Lawnville, Wallistown, Ngāhere and Te Anau. This provincial resilience is heavily supported by a robust agricultural sector, boosting local cash flow and consumer confidence, alongside the high initial affordability of these rural markets. Nationally, the median value for standalone houses dipped 0.1% over the quarter to $843,199, sitting 17% below historical peaks, with Upper Hutt registering the most severe contraction from the highest point. Auckland suburbs ranked amongst the country's weakest performers, with Wesley, Wirri and Glen Innes posting annual declines between 6.9% and 7.8%, as a result of an extensive new supply pipeline, affordability constraints and wary buyer sentiment. Wellington values face parallel downward pressure alongside public sector staff reductions, though buyers in areas like Lower Hutt are actively using their increased bargaining power to target lower price points. Townhouses and flats showed steady operational performance, with 52% of suburbs posting stable or positive value trends over the quarter, indicating that healthy relative demand is absorbing the ongoing influx of multi-unit supply. The market exhibits wide valuation gaps ranging from Auckland's premium suburbs like Herne Bay at a median value of $3.03 million down to 8 regional suburbs tracking below $300,000. Forward-looking projections indicate property values will continue tracking sideways nationally over at least the next 3 to 6 months, characterised by elevated listing choices and buyers who are retaining the significant negotiation leverage. The latest CoreLogic suburb data beautifully illustrates why you can't paint the whole country with one brush. We don't have one property market, we've got hundreds of them. Over 56% of New Zealand suburbs saw stable or rising standalone home values over the last quarter. Where is that growth hiding? It's in rural towns, smaller provincial hubs, and parts of Canterbury and Southland, where a strong farming sector is injecting real cash flow and confidence into the local economy. Meanwhile, traditional heavyweights like Auckland and Wellington are experiencing pullbacks because of public sector job cuts and a very healthy supply of new builds hitting the market. If you're an investor looking for stability, this data tells you that townhouses and flats are holding their ground incredibly well, with over half of all suburbs showing stable or rising values. Buyers have still got plenty of choice, which means your ability to negotiate a favourable deal is at an all-time high right now, literally called a buyer's market for a reason. Topic number 3 from One News on the 8th of June, why New Zealand renters may be about to have it better than Australians. Sounds like we're picking on our neighbours across the ditch with all of this media reporting about New Zealand versus Australia, but, tis what it is. Rental affordability's improved across almost every region in New Zealand over the past year, driven by a combination of softening rents and rising incomes. On a national basis, average rents now consume 39% of individual monthly earnings per job, reflecting a 5% drop over the year, with Auckland tracking at 39%, Canterbury at 38%, and Wellington at 35%. The west coast of the South Island ranks as the most affordable rental market in the country, with a typical weekly rent of $433 taking up 31% of an individual's income. Hawke's Bay achieved the sharpest annual affordability improvement at 9%, as weekly rents dropped by $53, while Wellington followed closely with a weekly rent decline of $42. While New Zealand's median rent burden as a share of household disposable income sits at 25.5% compared to Australia's overall average of 23%. Australian metropolitan hubs are experiencing far deeper rental stress, with rent devouring up to 54% of income on the Gold Coast and 48% in Sydney. Industry commentators attribute this trans-tasman divergence to policy environments. New Zealand's restoration of mortgage interest deductibility has coincided with expanding rental stock, whereas Australia is narrowing tax incentives, limiting negative gearing on existing homes, and that does nothing but choke supply. Economists note that while rental prices are fundamentally driven by a tenant's capacity to pay rather than a landlord's operating costs, mortgage data reveals a clear resurgence in the New Zealand property investor activity since early 2024 when tax rollbacks were confirmed. Looking forward, market projections point to a 3 to 4 year period of flat rents across New Zealand as a substantial wave of newly built townhouses enters the market from owners who need income from tenants to help cover the cost of those mortgages. My thoughts on this are rents coming down is great news for tenants, and it's not the end of the world for property investors, especially those who are looking at purchasing in the current market, because house prices have come down as well. We're actually seeing some of the highest rental returns that we've seen in about a decade. The latest regional rental affordability index serves up some incredible insights, especially when you compare us to the neighbours across the Tasman. Rental affordability is improved in almost every single region of New Zealand, which is great for the youth in this country and for people who aren't in a financial position to buy their own home. With Hawke's Bay and Wellington seeing weekly rents drop by $53 and $42 a week respectively, that means that there's more money in those tenants' pockets to pay for things like petrol and food, which is going up quite a lot. Now, when we look at Australia, they're heading into severe rental stress, with tenants on the Gold Coast or in Sydney spending up to half their income just to keep a roof over their heads. That makes it hard to save for a house deposit, right? But why the sudden contrast? At the end of the day, it comes down to policy settings. In New Zealand, the restoration of interest deductibility brought investors back to the table, expanding the rental pool. Australia, on the other side, stripping away tax incentives on existing homes, which chokes supply and drives rents up. It also pushes investors in Australia towards new builds, which is one of the areas where first home buyers are incentivised by the government in Australia to target that type of property as well. So that means that investors are going to be competing with home buyers, which just pushes prices up even further. A wave of new multi-unit townhouses coming online here, we're likely to be looking at a stable, flat rental market for the next few years, which gives tenants room to breathe, gives smart landlords a predictable environment to budget around as well. Not to mention the fact that, you can negotiate in the current market and get a really good purchase price. Not everyone's going to sell below value, but some people will, and having a solid tenant base to back that up as well. If you're getting value out of this podcast, please open up your Apple Podcasts or Spotify app right now and hit the follow button. It's the number one way to help us help more first home buyers and property investors gain access to quality content. If you'd like to learn more about investing, join me at one of our free online events called How to Succeed with Property Investing. In these events, we focus entirely on helping you to build the right mindset and the right strategy to create success. As a financial advisor and experienced investor, I'll help you to navigate the current market with more confidence and help you make smarter decisions. We're live, online, and independent. We don't sell property. Go to propertyapprentice.co.nz to register for the next free event. Topic number 4 from New Zealand Advisor on the 10th of June, the Auckland vote that could move property prices by up to 8%. Auckland Council's Planning Committee has voted to consult local boards and iwi on 2 competing options, Scenario A and Scenario B, to wind back the government-mandated Plan Change 120 housing density regulations. This adjustment follows recent legislation that reduced Auckland's mandatory minimum capacity requirements by 32.5%, moving the legal floor from roughly 2 million dwellings down to 1.4 million homes. Scenario A represents a stripped-back approach that satisfies only the legal minimums, concentrating development across 13% of Auckland to yield a capacity of 1.4 to 1.6 million dwellings. Scenario B stands as the more ambitious alternative, permitting 6-story apartments along transit corridors within 10 kilometres of the CBD and up to 15 stories near inner train stations, covering 15% of the city to enable up to 1.7 million homes. Council economic modelling shows that expanded capacity will reduce house prices over time. That good old supply and demand, forecasting a 1% to 2% price reduction under scenario A and a 5 to 8% decline under scenario B. The estimated 10-year economic benefit to the city diverges substantially between the two plans, projected at $700 million under scenario A compared to $3.9 billion under scenario B. A definitive decision on the scope of the density rollbacks is expected in July, keeping Auckland's current medium density development pipeline near transport routes in a temporary holding pattern. So my thoughts on this are Auckland Council's upcoming July decision regarding housing density rules is something every investor needs to watch closely. They're choosing between two very different paths for the city's future growth. Scenario A does the bare legal minimum, while Scenario B allows for taller 6 to 15-story apartment developments clustered tightly around train stations and busy bus routes, which makes sense, right? Because people who live close to public transport won't necessarily need to have as many car parks, and they'll have a cheaper option potentially to get to work. But we always have that whole NIMBY thing, not in my backyard. So no doubt that scenario is going to upset a lot of people. So it'll be interesting to see what happens. The council's own chief economist dropped a sobering piece of data. They project that the higher density model could lower house prices by up to 8% over time due to pure supply capacity, while injecting nearly $4 billion of economic benefit into the city over the next decade. I mean, it's going to be interesting to see how that plays out, because as population growth happens, that supply could be easily mopped up. And, it gives opportunities for first home buyers and keeps rents a bit more affordable for tenants as well. But right now, this debate has put the local development pipeline into a temporary holding pattern. If your strategy involves townhouses or apartments near transit lines, this July decision could fundamentally dictate the supply-demand calculator for your portfolio over the next 10 years. So what are your thoughts on this? Let us know in the show notes below. Topic number 5, New Zealand Herald on the 6th of June, Friends house share feud ends with disputes tribunal ruling. Neither owes the other a cent. A disputes tribunal case highlighted the severe risk of co-purchasing property with friends without maintaining legal safeguards after a breakdown in a joint ownership venture led to legal battles over minor household utilities and cleaning products. The co-owners bought a property together in July 2023 with unequal equity contributions, 75% and 25%, but their relationship dissolved by January 2025, leading to a tense living situation where one co-owner isolated his living quarters before eventually being bought out. The tribunal ultimately ruled the financial dispute an exact draw, ordering a nominal $233 offset for both parties to cover outstanding internet costs and retaliatory legal fees caused by a missed buyout deadline. Property lawyers report an increasing trend of average income earners attempting to enter an inaccessible housing market by purchasing real estate with friends or relatives other than renting. Legal experts warn that friends who buy together are classified under New Zealand law as standard business associates or tenants in common, meaning they're completely excluded from the protections of the Relationship Property Act. Joint buyers face severe financial exposure because commercial banks typically require co-owners to act as co-guarantors, rendering each individual fully liable for the entire mortgage debt if one party faces redundancy or financial distress. Property lawyers strongly advise co-buyers to consult legal experts to draft a comprehensive property sharing agreement before purchasing, ensuring that the document clearly dictates dispute resolution, asset division, exit strategies, and unexpected life changes like new romantic partners. So to round out this week, a recent disputes tribunal decision serves as a powerful reminder of how quickly things can unravel if you don't treat property like a strict business transaction. We are seeing a growing trend of friends and relatives pooling their money together to get their foot on the property ladder because solo entry has become a bit more difficult, although it is becoming more affordable on the daily. It's a great strategy to bypass renting, but you need to make sure that you have those agreements in place while things are still good between you. Otherwise, it causes a complete cluster. And just make sure that you get independent legal advice before you sign any contracts, and get financial advice from a mortgage advisor to make sure that you understand your liabilities to the bank. It's clear that the New Zealand property landscape's entering a highly rational strategic phase. Whether you're looking at the substantial drop in mortgage arrears as a sign of economic resilience, weighing up the lightning-fast speed of an auction campaign, or looking out to the regions for an affordable foothold, success right now is all about adapting your strategy to the current environment. I want to hear from you on this one. Should the government change the rules and allow Kiwis to use their KiwiSaver to buy a regional rental property under a rent vesting strategy? Or should it remain strictly for a home that you intend to live in? Drop your thoughts in our poll and let me know your experiences in the comments below. Have you bought a property with a partner or a friend and had things turn nasty, but you got saved by that relationship agreement? Let us know what's going on. If this breakdown gave you a clearer perspective on the market this week, please smash that subscribe button and give this video a like. It really helps us cut through the mainstream media noise and reach more Kiwis who want to take control of their financial destiny instead of getting bogged down with all the bad news and clickbait. And look, if you want to learn how to find those high-performing regional assets under the $500,000 mark and build a portfolio that thrives while the main centres take a breath, come along to our next free online session. We don't sell property, so you don't have to worry about me flogging off any dodgy new deals or anything like that. Just we'll give you the advice and support that you need. But the event online is completely free and no obligation to become a client, except for those of you smart enough to want our help. So secure our free spot right now at propertyapprentice.co.nz, and I'll see you in the next episode. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.